Very good morning to everyone. We have started from investment, various investment plans, and these investments have been invested in the various avenue, and how this mutual fund has been invested in various investment plan, and based on what objectives. So we have discussed in the previous class five important different types of objectives and the investment plan, and the source of revenue, where exactly it is invested, and which types of investment is invested where. So coming to the sixth one, which is called exchange traded funds, and it is also said some mutual fund investment is made in exchange traded funds, and which is also called for diversification of their investment plan or specific market exposure. So let me discuss about what is all about the exchange traded fund. So exchange traded fund is an investment vehicle that pool of the group of securities. I can tell you it is a pool of market security. It is similar like your equity, or it is similar like individual stock where it can be traded. So it is also said that is an exchange traded fund is an investment vehicle that pool a group of securities into a fund. Okay, so indicate like traded like an individual stock in the stock exchange. Now, what is an exchange traded fund exactly? If you want to see, an exchange traded fund is an investment fund who multiply underlying assets and can be bought and sold same like an exchange, and much like an individual stock. They are structured track anything from the price of commodity to a large and diversified collection of stocks. Now, ETF can be even designed to track the specific investment strategy. So there are various types of ETF available to investor for income generation. People can buy different types of exchange traded funds, and these are available to investor for income generation, like speculation based on the future speculation, or hedging the risk in an investor portfolio. Right. Some of the key takeaway like an exchange traded fund is a basket of security that trades on exchange just like stock one. And this ETF share prices fluctuate throughout the trading day. And this is different from a mutual fund, which only trade once a day after market closes. Then ETF offer low expense ratio, fewer brokerage commission than buying stock individually. Now, how it works, especially like an ETF must be registered with the Security Exchange Board, especially Security Exchange Commission, we call SEC. Um Based on that, there are different classification how it can be traded. There is no transfer of ownership because investor buy a share of a fund which owns a share of underlying company. So unlike mutual fund, ETF share prices are determined throughout the day. So mutual fund trades only once a day after the market close, right? So this is how it goes on. So exchange trade one of the classification where it has been spent in different way, and in money market instruments investments are made, different types of investments, and how it is classified, and how this is one of the investment pattern where different objective have been classified. Next is the derivative. And derivative, here the purpose of derivative to manage risk or enhance the return. Managing risk. So it is also called financial contracts. Derivative is also called as a financial contracts. And their value is determined by the value of an underlying asset or set of assets. And you can see the example. When I said about purpose of derivative will be managing risk or enhancing the return. So managing risk means like we never know that how much risk attached to the investment, based on what we never know that what investment will yield what type of return, what investment will have a high risk. So the main purpose of derivative market, it talks about it will handle or to manage the risk whenever it is necessary, and it will enhance the return which is expected. So with the example I can tell you stock or bond or currency, commodity, market indices are all common assets underlying the asset value. So The underlying value, if I said, you can say example here, it's given derivative use typically limited to certain types of funds or regulated carefully. So derivative is a securitized contract. I can tell it is a securitized contract whose value is dependent, and it is always understood again based on the understanding. It also said the possibility of different types of derivative, like I give an example about forward are not traded on any central exchange but rather over counter. Then you have a different type of options. Options are financial contract in which the buyer or seller has the option to buy or sell a security or financial asset. Then if you see the future or financial contract that are basically identical towards forward, and with the main distinction being features can be exchanged on exchanges, so resulting standardization regulation. Then swap, you have the swap is kind of name implies exactly what they sound like. Swap are type of financial derivative used to convert one type of cash flow to another. So swap are private agreements between the party that are primarily exchanged over the counter and are not traded on the stock exchange. So swap is not traded on the stock exchange. Then there are derivative how it is traded. So we need not to worry how it is traded, but we should know about what are the purpose of main derivative. So derivative we have seen here, managing of risk and enhancing the return. The final one is the eighth one. It is an international emerging market investment. So investments in different avenue, where when it's come for avenue, mutual funds are invested in various investment schemes, and international emerging market investment in foreign stock, bond, money market instrument. It will provide the geographical diversification and the growth opportunity. This is what is important investment avenue where mutual funds are traded. So mutual fund is invested in various investment opportunities. So this is the eight points of investment. Then you have a ninth one, hybrid investment. So hybrid investment in form of hybrid instruments. So here it is given funds like balance or asset allocation, funds like balance or asset allocation, and there's funds like asset allocation, how it being used, and fund allocation invests in mixed stocks, bond or other security, balance risk or return. So when it's come for hybrid, these are the security by which being a specific parameter, and it possesses elements of both debt security as well as those character of equity. So hybrid instrument, see the combination of debt and equity become hybrid instrument. So here they said fund like balance or asset allocation fund invest in the mix of stock, bond or other any security, balance risk return profile. So I have said that these are the security by which being given specific parameter. They are the element of both debt security as well as those character of equity. So usually bond or debt security have a specific element bringing the closure of equity instruments. Then a hybrid instrument in form of also called as an income instrument, like that combine element of shares and corporate bond, and they considered to be placed somewhere in between debt and equity. So if you go for example fixed income instrument such as like loans and bond, most common means of financing when fixed income sure include business, government, and not for profit that promise to pay interest or repay borrowed principal to investors. So all these are alternative hybrid instruments. And the 10th one, you have an alternative investment. One of the investment chosen in mutual fund is an alternative investment. Certain mutual fund, especially specialized one, may invest in the private equity, hedge fund strategy, or infrastructure projects. So each type of mutual fund focus on specific set of security aligned with the investment objective, the growth, income, or capital preservation, and always review the fund prospects to understand its specific investment strategy and set allocation. Asset allocation is done clearly under alternative investment. So if nothing is there, this is alternative, so that can be concluded when it's come for various investment made by mutual fund investors. Now coming to the next slide, this slide talks about various investment objectives. Investment objective we have gone through. For investment objective, why this investment objective especially is required to know every investor, and everyone know that every investor objective will be profit maximization, or more and more profit earned and reduction in the risk. So mutual funds seek to mobilize money from all possible investors. Various investors have different investment preferences, and this preference mutual fund mobilize different pool of money. Each such pool of money is called mutual fund scheme. So every scheme has a pre-announced investment objective. Investor invests in mutual fund scheme whose investment objective reflects on their own needs and preferences. And I have explained you people about all the schemes in the previous classes about overnight fund or equity fund or hybrid fund or long-term duration fund or long duration fund, how this investment objective has been fulfilled. So first investment objective is like mutual funds are designed to meet specific investment objective based on the investor goal or risk tolerance and time horizon. Like people are the main investment objective and strategy mutual funds used to achieve them. So number one objective is a growth. Why we invest in mutual fund, and the investment objective of this mutual fund is in growth. Every investor would like to know about what is the growth of his fund, what is the growth of his investment, how long this growth can be expected, and what profit can be recovered based on what kind of investment. So growth objective to achieve long-term capital appreciation by investing in the asset that have the potential to increase in value over time. So growth reflects on to achieve long-term capital appreciation by investing assets. So you know, right, if you invest one stock today with one price and you hold the same stock for the longer period, it can be any investing in any of the mutual fund, and growth is the main objective as the primary objective, and every company, every individual, every stock, every investor would like to know about what is the future growth and what is the future return can be expected from this kind of investment. So it talks about achieving the long-term capital appreciation by investing in the asset that have the potential to increase the value over time. Now, what are the strategy of this objective will be? Invest primarily in stocks, especially growth stock, company with the high growth potential, focus on industry sectors with the strong future prospects, then include international emerging market equity for diversification, higher potential return, little no emphasis on generating regular income. So there are different types of strategy in the growth context, the growth point of view. Long-term capital appreciation is the key here, and investing in an asset which had a potential to increase the value over time. And this is the strategy when it comes to investment into primarily stocks or equity or any term. Growth is necessary. Investment should yield some return, or might be the future expected, or which can fulfill the dream of every investor in form of any profit. So example, growth, again the large cap growth fund, mid cap and small cap growth funds, sector funds. I said investor would like to invest in technology, biotechnology, or manufacturing segments, or automobile industry, or many other. And I have said about when it's come for income, income is the main motive of every investor. They would like to invest more and more in form of different return, different classification. And here income, I said, generate regular stable income for investor, often through interest or dividend. And I said example also, investment in form of what, investment in form of return, investment in form of classification, investment income of different for the reference. So here invest in dividend paying stocks, fixed income security like bond, one of the strategy, Then focus on security with consistent yield, high quality corporate bonds, then government bond, preferred stock. And if you see here, when I was talking about the focus of security, a consistent yield, like consistency will be which stock is preferable and which stock will yield more return, and which stock year by year will give more and more return compared to the rest of the security. So the main objective is the regular income or the stable income. Many people would like to invest in the many of the long-term fund because they want to see the stable income rather than risk taking. But at the same time, they just go for different type of diversification of this income. So instead of putting money in one particular basket, they just diversify into different category where the pool of money from one sources is less, pool of money one source is average, one might be go high. So they become average of investment getting a fixed rate of income. So strategy, invest in dividend paying stocks, fixed income security like bond. Then when I talks about fixed security like bond debenture, this will yield fixed rate of return. The percentage of fixed rate of return is expected. Like you invest and a company or the government sector or the banks, they just go for fixing on percentage of return in the name of interest what they're going to pay, or in the name of any kind of a return what they're going to classify. So here focus security with consistent yield like year by year, or high quality corporate bonds, government bond, preferred stock, whether they will yield what consistency year by year. So that is taken into consideration. Then maybe include, I said, real estate related trust or ETF fund transfers, or balance risk by avoiding overall wallet investment. These are the strategy where the investment objective are preferred. Then example like bond funds, high dividend income funds. Then you have a high yield fund where you're going to invest and get high return at the same time with the high risk. So these are the attachment what you can go through for when it's come for meeting of objective of individual or the stakeholders. Then the third one is a capital preservation. Like the main objective of capital preservation, protect the principal investment with minimum risk, and ideal of conservative investor short-term goal. And I'll give example about preservation of capital or principal investment. Every investor would like to invest in a company and see the safety of his investment, where he can control that investment, and how this monitoring can be done with the risk return profile. So here capital preservation talks about protecting the principal amount which is invested in the company. So you take example, if 1 lakh is invested and you expect that minimum on 10% in annually where I should get return meets minimum, and how investment or principal investment is safe with the minimal risk. So I'll just go for identifying which are the main objective where I can keep my investment at the safer side. So preserve or keep reserve it in case of emergency, how to avoid the risk. And the ideal conservative investor or the short-term investor is the main goal here. Then it's come for strategy, investing in the low risk security like a money market instrument, government bond, treasury bills. One of the strategy of capital preservation, I invest in the low risk security. When I tell low risk security, you get the profit also not with high but average or low profit. Why? Because you are fixing your income based on the instrument which will yield 100% return. If there is profit, no profit also, but you get a return of one fixed, where the risk also less and the return also less. So some people use the strategy under capital preservation, like invest in the low risk profile, example I said money market instruments, and maintain high liquidity for quick access to funds. So simple, like liquidity, like any kind of a gold or any kind of a instrument which can be converted so easily and convert into money or funds at any time or into a quick access. So maintaining of high liquidity for quick access to funds also possible when it's come for capital preservation, one of the strategy. Then prioritize the safety over growth and the income, high income. 100% when I see high income beyond with the running beyond with the high income, I should see my safety of my investment also. Many times with the huge expectation of return, we forget about the safety of our investment. So prioritizing our safety over the growth of the income or high income in return of high income. Example here, money market funds, short-term funds, or ultra short duration funds. This is the example. And now remaining types of objectives of investment in the mutual fund I will be explaining in the next class. Thank you all for listening.